Hello and welcome to our other series of mathematics lesson. In our last lesson, we discussed about income and different types of incomes, where we said that people normally earn depending on whatever value or amount of work they do. And when we were checking on the incomes, we said that there are three main types of incomes. Basically are the salary, wages. We said that on salaries, these ones are normally paid on weekly basis or on monthly basis or sometimes fortnightly on the work that a particular person or individual has done. We also talked about wages, and we say that in wages, people are normally paid on daily basis or on hourly basis depending on the kind of work that they were doing. We also said that there are some kinds of PAYGs which normally come when people do the sales service or the sales job, which is referred to as commission. It is important to note that when these individuals receive these particular incomes, they must be taxed by the government for the government to be able to provide services for the civil or for the society or for the citizens. Now, we are going to look at the pay-as-you-go income tax system. And in this particular system, we are going to consider a government that gets income from the tax activities or from the incomes of people for it to be able to participate in provision of services such as education, hospitals, construction of roads, construction of railways, airports, and other essential services to the common citizens. Yearly, the government normally has a budget which is normally passed at the end of every financial year. This budget normally captures the incomes from such taxes which come from the citizens and who are paid by the government. We are going to consider a three-cycle system on which income normally flow. We are going to look at three individuals. One is the employer, whom we'll refer to as the B. Two, we are going to have the employee, whom we are going to refer to him by a letter U. And three, we are going to have the tax authority or the revenue authority. We refer to him as T. Now, we have said that this B is the boss. In this particular case, we are calling him the employee. Sorry, the employer. And U is now an employee, while T is the revenue office. It is important for us to note that U normally works for B, and B pays you for the work done. That's why the arrows are pointing on either side. That means that B pays you when U works for B. At the end of every week, or every month, or every fortnight, B calculates, before paying you, the amount of tax he's supposed to remit to the government. Then at the end of the month, B will send that particular amount of money in form of tax to T, who is the tax or the revenue office. The revenue office in return will be able to provide or to send that particular money to the federal government, and the government will be able to provide services to the common citizen U. That's why the arrows are pointing in those particular direction. On June 30th every month, T furnishes you with the summary of how he has been paying the tax. We refer to it as the payment summary. And from that particular payment summary, you can be able to see how he has been paying the taxes to the tax office and how T has passed the same to the federal government. Now, on the following day, that is on 1st July, actually to October, you will be involved in filing what we call the tax returns. And on filling these particular tax returns, it can be possible that you could have overpaid or could have taxed you more. In that particular case, we refer to it as an overpayment of tax to T by you. In that particular case, you can be able to demand to be refunded some particular amount of money, which we refer to it as tax refund. Now, it is also possible that during the calculation, B could have given T less amount of money as to what it was supposed for you to pay. In that particular case, we'll say that U has underpaid. And if there's underpayment of tax, then U has to pay some more money, which we refer to it as tax liability. So in a nutshell, we are saying that at the end of making the payment or the summary, we can have an excess payment or we can have a deficit payment. In case of excess payment, then we have tax refund, which is given back to the account of you. But in case there was a deficit in paying the tax, then you has to pay more, which we are referring to it as tax liability. There's a tax table which is normally provided by T for the purposes of calculation of tax. That is what we want to look at it now. It has got two columns. On the first column, we have what we call the taxable income. And it's usually in pounds. Then on the other side, we have tax on the income. So the income tax department normally prepares a tax table on how the citizens are supposed to pay taxes depending on the levels of income they receive. So the table consists of two columns. The first column is the taxable income, usually in US dollars. Then on the other side, we have the tax, which is supposed to be levied on that particular income. Between 0 to 18,200 US dollars, a citizen is not supposed to be taxed. Therefore, he pays nil tax or zero tax. And then between US dollars 18,201 to US dollars 37,000, this individual is supposed to be taxed at a rate of 19 cents for every dollar over 18,200 dollars. On the third band, between US dollars 37,001 to US dollars 80,000, a citizen is supposed to pay a fixed charge of US dollars 3,572 plus another 2.5 cents for every dollar over $80,000. Then on the fourth band, between 80,001 US dollars to 180,000 US dollars, a citizen is supposed to pay a fixed charge of 17,547 pounds plus 37 cents for each dollar above $180,000. Finally, on the last band, that is between 180,001 and over, a citizen is supposed to pay a fixed charge of 54,547 US dollars plus 45 cents for each dollar above 180,000. Now the source of this particular table is the ATO, or the Australian Tax Office website. We are going to consider several examples on which this table can be used in calculation of tax for individuals who are receiving different levels of income. Example: during the 2011 to 2012 financial year, Richard earned a total of 1,050 US dollars per week. This 1,050 US dollars per week represents 54,600 US dollars per year or per annum. From his employer, and other sources. He has receipts. For 3,375 US dollars for work-related expenses. And donations. Now here is an individual, Richard, earning a total of $1,050 per week from his employer and other sources such as investments. Now he also has receipts worth $375 for work-related expenses and donation. The requirement here is that we find the amount of tax that Richard is supposed to pay to the income tax department. Now, for us to be able to calculate the amount of income that the amount of tax that Richard will pay to the income department, we need to know where or his taxable income, because not all income is normally taxed. We normally tax what we call the taxable income. And for us to be able to get the taxable income, we take the total earnings of Richard and we subtract any other work-related expenses and even the donations. So we subtract what we call the deductions from his pay. These deductions, it is important for us to understand that they are referred to as allowable deductions, meaning that not any other deduction can be subtracted from the total earnings of this particular individual. We need to subtract what we call the allowable deductions. And allowable deductions can be in form of donations. Maybe Richard gave out some money to a charity organization group. That is an allowable deduction. We also have other legitimate deductions which can be able to include things such as insurance. So if Richard had taken an insurance with an insurance company, maybe covering his life or that of his family, then under that we must also subtract it as an allowable deductions. But in this particular case, we only have one deduction, which is US dollars 375. That means that the taxable income of Richard will be US dollars 54,600 per annum. We subtract $375, which is in form of deductions. This one will give us a taxable income of $54,225. That means in a year, Richard has a taxable income of $54,225 US dollars. This is the amount of money that is supposed to be taxed by the tax department. Now, for us to be able to calculate the tax that is allowable on this particular amount of money, we need to go back and check at our table. So our table provides that between 0 to 18,200 US dollars, there is no tax that is paid. So $54,225 for Richard falls in the third band, that is between 37,001 to 80,000 US dollars. And if it falls in this particular third band or tax bracket, then that means that Richard is supposed to pay a fixed of 3,572 US dollars. Then on anything above, sorry, this was 18,200 on, sorry, 37,000. On anything above 37,000 is supposed to pay 32.5 cents. So the tax liable or payable by Richard will be US dollars 3,572 plus 32.5 cents. We know that 32.5 cents is the same as 32.5 all over 100 pounds. For every pound over 37,000, and he is earning 54,225. So anything above 37,000 will be 54,225 subtract 37,000 US dollars. This will give us 3,572 plus, when you calculate 32.5 cents of 54,225 minus 37,000 dollars, we are going to get we get $5,598.125. When added to 3,572, we get that Richard is supposed to remit 9,170.125 US dollars to the income tax department. Now, normally when we are dealing with money, we normally truncate to 2 decimal points. That means that this particular individual or this particular amount of money can be approximated to 9,170.12. This 9,170.12 pounds is supposed to be remitted by Richard to the income tax department. Now, every month or every fortnight, we can have other deductions from Richard's income towards a particular organization or to a particular insurance fund. In all governments, we normally have a section of the basic income going towards the income. And in this particular government, 1.5% of the taxable income is normally supposed to be given to a Medicare industry or to a Medicare insurance company for coverage of the health or the health insurance of a particular individual. So in this particular case, if Richard is supposed to pay 1.5% of his taxable income to a particular organization for medical cover, then he is going to pay a total of, that's 1.5% of taxable income, which will be 1.5 all over 100. And we remember that our taxable income was 54,225 US dollars. So he'll pay he'll be able to pay a total of 813.38 US dollars for coverage of his life. At some particular instances, we can be asked to calculate the total deductions. Now remember that Richard is paying 813.38 to a particular Medicare firm for coverage of his health or Medicare. That means that on top of this, he's also paying a tax which is equivalent to 9,170.12. So total deductions for Richard will reach So we add the two, that is 9,170.12 plus 813.38 US dollars. That means that every year a total of, when you add 9170.12 to 813.38, so the total deductions for Richard will be 9,170.12 plus 813.38, which gives us a total of 9,983.50 as part of the deductions that come out of his pay. Now, I've said that sometimes you can be asked to express these deductions as a percentage of his total taxable income. So when you're asked to do so, then you can be able to find that the deductions that are made on Richard's pay is equivalent to a percentage of 9,983.50 divided by the total taxable income, which is 54,225, multiplied by 100%. This one will give us a total of 18.41%. Now this one I've rounded off to the nearest 2 decimal places. Now we discovered that Richard is supposed to pay 9,170.12 to the income tax department. Suppose that the employer of Richard did not pay out 9,170.12, and let's say he made a payment of 7,000 $7,797 US dollars. Now, in this particular case, T has not satisfied the condition by the tax authority and he has paid less. That means he has paid 7,797 US dollars as opposed to the US dollars 9,170.12, which was supposed to be paid. What will happen for instance, in this particular case? So we'll discover that there's a deficit in terms of paying the tax, and therefore the government will demand that Richard adds up or tops up this amount to a total of 9,170.12. In that particular case, Richard has what you call tax liability. And this tax liability will take the normal or the original amount of tax you're supposed to pay, which is 9,170.12 US dollars. We subtract the amount that was remitted by his employer, which is US dollars 7,797. So when you do that calculation, you will discover that Richard has a tax liability of he has a tax liability of 1,373.12 US dollars, and he'll be forced by the government to deduct this amount of money 1372.12 US dollars in the next financial year to pay the government or the federal government. But in case his employer had overtaxed him and maybe charged a total of 10,000 US dollars, this one is much higher than what was expected to be paid, and therefore Richard is going to have a tax refund. For us to get the tax refund, you get the amount that was paid to the tax department, which is 10,000 US dollars. We subtract the amount you're supposed to pay, which is 9170.12. Now, when you get that calculation, you'll discover that Richard will have a tax refund of US dollars 829.88. So from this particular explanation, what is important for us to know is how we calculate taxable income and how we apply those particular brackets in coming up with the amount of tax that's supposed to be paid by an individual to the income tax department. In conclusion to this particular part, we have said that taxable income is normally given by total earnings. Sometimes we refer to it as gross income minus any legitimate deductions. And these legitimate deductions, we have said, can be in form of donations that one has paid to a charity organization, or sometimes it can be work-related expenses. So if Richard, for example, had traveled using his own money on a business trip or on a work-related trip, then it's supposed to be, that becomes a legitimate deduction which is supposed to be deducted before calculating the taxable income. We also want to look at other instances or other examples. Brad's Medicare levy was US dollars 1,312.50. We said at the other time that Medicare levy is only 1.5%. So this represents 1.5% of his taxable income. So we can be asked, what is his taxable income? In this particular case, we have the levy, which represents 1.5% of the taxable income, which is 1,312.50 US dollars. For us to be able to calculate Brad's taxable income, we say that this is 1.5% of his taxable income. Therefore, his taxable income represents a wholesome 100%. So we'll ask ourselves if 1.5% does represents a fraction of 1,302.50, what of 100%? This one will give us 100 divided by 1.5 multiplied by 1312.50, which will give us 87,500 US dollars. So Brad has a taxable income of 87,500 US dollars. From there, you can be asked to calculate his tax that he normally pays to the income tax department. In our previous discussion, we have seen that there is something called legitimate tax deductions. Legitimate tax deductions, we said, are deductions which are normally made on the income of an individual after the earnings. And we discussed and said that there are two main, which are donations to a charity organization or any work related expenses. Now, these work related expenses and the donations are supposed to be deducted for us to be able to calculate the income or the taxable income of an individual. Example: Jen has an income of US dollars 80,000 from her employer and other investments. She founds a receipt of 100 US dollars donation to a registered charity organization. To a registered charity organization. What is Jen's taxable income? Now, we have seen that for us to be able to calculate the taxable income of Jen, we take all his earnings, which we have referred to it as the gross earnings, and in this particular case it is 80,000. Then we less any legitimate deduction, and in this particular case we are discovering that Jen has a legitimate deduction of 100 US dollars, which she has given to a charity, a registered charity organization. This will decrease the amount Jen is supposed to pay as tax, because this taxable income will automatically be lowered or decreased by this donation. So the taxable income for Jen will be 80,000 US dollars less the 100 US dollars which was issued out to a charity organization. This will give us 70,900 US dollars. That is Jen's taxable income. You'll discover that by paying the 100 US dollars, Jen will have shifted up by one bracket in the tax band, and therefore is going to pay less tax as compared to when she did not give out the charity of 100 US dollars. We can have another example. Has come to the end of her first financial year as a teacher. On June 30th, she made notes in the table to the right about the financial year. So the table also has two columns. In the first column we have gross income from employer, which totals up to $58,725 US. Gross income from casual job, another $7,500 US. We also have interest on investments, $75. She also makes donations to a charity organization, and the donations works up to $250. She also has work-related expenses, which totals up to $425. Then the tax paid during the financial year is $13,070 US. Given that these are the notes that are made by Lee concerning his income during a particular financial year, we can be asked to get to calculate different things from this particular table. We can be asked, for instance, part A, to get the taxable income that comes to Lee. Now, for us to be able to calculate the taxable income that comes to Lee, we need to observe how many sources of income does she has. Like in this particular case, we have the employer who gives her $58,725 US. She also undertakes other casual jobs for which she's paid $7,500 US. And then she has made an investment which gives her a total of $75 US. So the taxable income of Lee will be equivalent to his gross income less deductions. Now for the gross income, we'll take $58,725 US plus $7,500 US plus $75 US. Then we less deductions. There are two deductions here. We have $250 and other related expenses, work-related expenses, which is $425. Then we have tax. No, the two, $425 and $250. So the taxable income will be this gross income minus 75, which are donations, plus 250, which are work-related expenses. This will give us 66,300. We less 325 US dollars. So the taxable income in this particular case will be 65,975 US dollars. So this is a prudent example on how we normally calculate taxable income. We have said you take the gross income, you less all deductions. And when you're lessing deductions, always remember that we only less what we call legitimate deductions. So in this particular case, Lee had 2 legitimate deductions, that is donations of 250 US dollars and other work-related expenses of 425 US dollars. Finally, you can be asked to calculate how much Lee took home. That is what we call net income. Now with the net income, you take the gross income, which in this case will be 66,300. You less all other deductions, and now these all deductions will include up to the tax which you paid during that particular financial year. So apart from 325 on donations and work-related expenses, other deductions will be the tax. So this will be 325 plus the tax, which is 1370. That means Lee will take home US dollars 64,605. That brings us to the end of this lesson on the pay-as-you-go income tax system. Next time we shall look at issues to do with interest, that is simple interest and compound interest. Thank you.